This video covers Learning Objective 4, Journalize Transactions and Post Journal Entries to the Ledger, in Chapter 2, Transaction Analysis. So let's get started. First, we need to cover some vocabulary terms. A journal is a chronological record of transactions. A ledger is where we combine all the individual accounts. Posting is the process of copying information from the journal to the ledger. The journal is a chronological record of all company transactions listed by date, but the journal does not indicate how much cash or accounts receivable the business has. The ledger is a grouping of all the T accounts with their balances. For example, the balance of the cash T account shows how much cash the business has. The balance of accounts receivable shows the amount due from customers. Accounts payable shows how much the business owes suppliers on account, and so on. This diagram shows how asset, liability, and stockholder equity accounts are grouped in the ledger. Revenue and expense accounts also appear in the general ledger. Entering transaction in the journal does not get the data into the ledger. The data must be copied to the ledger, a process called posting. Debits in the journal are always posted as debits in the accounts, and likewise for credits. This diagram shows how a stock issuance transaction is posted to the accounts. The debit to cash will flow down to the debit or left side of the cash T account. The credit to cash in the journal entry will flow down to the common stock T account and will appear on the right-hand side or the credit side of that T account. The basic flow of accounting data is that first the transaction occurs and then the transaction is analyzed. Once analyzed, the transactions are entered into the journal. Then the amounts are posted to the ledger from that journal. Let's go through an example now. Gracylane is a store in Kent, Ohio. It purchases some of its inventory from Solmate socks. These transactions we are going to go through are fictitious. Before we do the journal entries, let's review a few things from the prior videos. The first question reads, when Gracylane buys socks inventory from Solmate socks, trademark, on account, Solmate socks has and what? The choices are accounts receivable or accounts payable. The answer is accounts receivable. Solmate socks has accounts receivable because Gracylane is its customer. The second question reads, when Gracylane buys socks inventory from Solmate socks on account, Gracylane has what? The choices are accounts receivable or accounts payable. The answer is accounts payable. Gracylane has accounts payable because Solmate socks is its supplier or vendor. Now we have the transactions to record. Gracylane purchased sock inventory on account for $5,000. Later, Gracylane paid $1,400 on account. Journalize the two transactions for Gracylane. The first transaction is highlighted on the screen. Gracylane purchased socks inventory on account for $5,000. Remember that we are journalizing these transactions for Gracylane. Gracylane received inventory and asset, so it has an asset increasing for $5,000. An increase to an asset will be debited. The other side of this transaction is accounts payable because Gracylane owes the $5,000 to its vendor, Solmate socks. The second transaction to record here is when Gracylane pays $1,400 on account. This means that Gracylane is paying $1,400 to Solmate socks towards the total amount it owes. What is happening here is cash is decreasing because Gracylane is sending the money. We have cash being credited to decrease it. The debit will be to accounts payable. Gracylane is decreasing what it owes here. So those are the two transactions in this hypothetical example. Now we need to post those two journal entries to Gracylane's T accounts. I've set up the T accounts for cash, inventory, and accounts payable. First, we will take the inventory debit and debit inventory in the T account. Remember that in T accounts, the debits are always on the left and credits are on the right. That will not change regardless of the type of account. Next, in the journal entry, accounts payable is credited for $5,000. So we will put that credit on the right-hand side of the accounts payable T account. Okay. Next up, we have a debit to accounts payable for $1,400, so we will debit the accounts payable T account. That $1,400 is on the left-hand side since that is the debit side. And finally, we have cash being credited for $1,400, so that credit will appear on the right-hand side of the cash T account. This process of transferring the numbers from the journal entries to the T account or to the accounts in general is called posting. Now we can answer the question of how much does Gracylane owe? To get the balance of any T account, we draw a line under all of the activity. Then we add the debits and we add the credits and we take the difference between them. The difference between $1,400 and $5,000 on an absolute basis will be $3,600. It will go on the side that is larger. We have a credit balance in accounts payable of $3,600. This $3,600 credit balance in accounts payable makes sense because Gracylane still owes Soulmate Socks $3,600 from that initial transaction. Now we have a few more knowledge check questions coming up to test your understanding of this material. After I read the question, pause the video and try to answer it. Once you restart the video, I will be walking through the answer for the question. Let's go. The next question reads, which of the following is an asset account? The choices are retained earnings, accrued liabilities, accounts receivable, or accounts payable. The answer is accounts receivable. Accounts receivable is cash the company will receive for delivering a good or service. Retained earnings is not an asset. It is part of equity. Accrued liabilities are a liability. Accounts payable is a liability. The next question reads, when a company borrows cash from the bank, the choices are total assets remain the same, liabilities are increased, retained earnings is decreased, or total liabilities remain the same. When a company borrows cash from the bank, it will receive cash, an asset. So assets will increase. On the other side of this transaction is the fact that the company owes the bank the money, which is a liability. So liabilities are also increasing in this transaction. The only answer that fits will be B, liabilities are increased. That concludes our review of journalizing transactions and posting journal entries to the ledger. Thanks for watching.